Alright, so today I'm here with an extremely valuable video to anybody that's trying to learn how to trade profitably on the 5-minute charts. The strategy I'm teaching has consistently proven itself to be, well, from my experience, the best strategy out there, and that's over multiple different tradable timeframes. And it's much more simple than a lot of the strategies you see online. And yet it's established itself as being one of the strongest out there, and if you watch this video in its entirety and keep all the information in mind, literally all you'll have left to do is work on the psychological side. So let me just get straight into an explanation of the strategy itself. So this is basically going to show you the basis of liquidity, supply and demand, and why it works so well in the live markets. So essentially how it works is this. Just imagine that these are candles printing on the charts. So first, what we need to see for a demand example is a big push up. What this does is it forms a normal, strong demand zone at the bottom here. If you don't know how normal supply and demand works, basically what's happened here is we've pushed up so quickly with so much momentum that investors, institutions, banks, etc. will have missed their original entry down here. And this is the best opportunity to get in at a good price. So typically what people do is they'll wait for price to come down to these areas in which investors will then see that we're back at a good price, and then they'll take their entries and we get our little piece of it. But for our strategy, what we're looking for is for price to come down with a little retracement, not tap the demand zone, and then break the high to the left, this being the high that we need to break, of course. Now stay with me here, trust me, this is extremely simple. But now what do we have here? Not only do we have a low that's formed, which of course liquidity will sit under. If you don't know, liquidity will always sit below lows like this or above highs like these. It's basically at all swings, there will always be liquidity there. But we have also formed another demand zone right here. Now the issue with normal supply and demand, which is quite possibly the most popular strategy out there, is that the markets are yet to fill every condition that they need in order to fully push off and commit in your direction. Now what I mean by that is the main thing it's missing is taking a level of liquidity and also being at a good price. Those are two extremely important things when it comes to supply and demand in my opinion, and trading at how most people do without these factors is much more difficult to get a consistent profitable equity curve over long periods of time compared to if you trade liquidity, supply and demand. But just think, of course, investors, banks and institutions will always be wanting the best price in order to fill their millions of dollars of orders at, and with liquidity, supply and demand, we're making much larger moves to the downside before we're expecting it to continue bullish. So in a situation like this, we're waiting for price to move down another 80 pips between the two different zones here, and just think 80 pips to these institutions, banks, investors are tens of millions of dollars. So trust me, they do care about that extra bit of movement. So essentially this strategy is taking advantage of those two factors and using them to give us a much better win rate and risk to reward. So basically what we're expecting to happen in the live markets is for price to come to this top zone right here where normal supply and demand traders will be entering at. You'll more than often see small reactions come from these zones, and this will just be normal supply and demand traders entering. And this is great for us because that means they're putting their stop losses below the candles or below the low right here. And with their stop losses being in place, this is just extra liquidity for our zones to win. And by price taking these stop losses, this is just giving us extra momentum for our zone to win. Liquidity is definitely one of the biggest influences on the market by far, and the fact that normal supply and demand doesn't take advantage of just taking liquidity before coming to zones is quite crazy to me. It's actually so important to have that in place in my opinion, and having that alongside just getting a way better price, once again 80 pips in this example, is pretty obvious which zone will be more desirable to investors. But as somebody that used to trade normal supply and demand, you can literally see back on my channel, I would always experience myself losing just for price to go down a couple more pips and then go in my direction. And what I never realized was that it was just these liquidity, supply and demand zones playing out. These move the markets way more, trust me. I know most people that watch my channel already trade this strategy. Everyone already knows it works, but if you're new to it, then I want you to backtest this after you've watched this video. I'm going to show you all the tricks you'll need to be able to trade the strategy. But we are getting in right at the bottom of this move right here. So we're catching a bigger move from a more likely place to win, getting more momentum, whilst normal supply and demand traders will have lost on this zone, and then maybe on the way up, they'll catch a little win somewhere over here. They'll get their 1-to-1 risk to reward or so, and then price will obviously need to retrace, whilst we're getting to eat off this entire move right here, or often more, because price will obviously retrace, and if your directional bias is correct, then it will just continue up. You can catch easy 1-to-10s like that. And the great thing about this strategy is that there is a proper rule book, so you can have fully intricate rules that allow you to know exactly what you're doing all the time, rather than just entering based off intuition that maybe isn't even that strong. So before I continue with showing you how to trade the strategy properly, let me just show you a few examples of how this works. So firstly, with this trade on GBP JPY here, you can see exactly what I've just explained playing out right here. So right at the bottom of this move, we had a demand zone. I'll explain how to draw them out, of course, but this is the demand area right here. We came up very strongly. Institutions, banks, they would have missed out on this zone for sure. We then came down, made our level of liquidity. Of course, we did come down multiple times here, which just makes even stronger liquidity, but that's not even necessary. We then came up, breaking the high to the left here. This makes the liquidity stronger. It confirms that we're still bullish. And then we came directly down, reacting from this zone right here. You can see we got a really good rejection from it. Normal supply and demand traders are hyped. This looks like a great zone for them. If you ever traded normal supply and demand, this zone looks actually gorgeous. I mean, even if you haven't, you can see there was a massive push up. They think this is right at the bottom of the area because obviously they're not really considering this zone here. So this looks great for them, which is why it got such a good reaction right here. They're all getting hyped, you know, entering around here, looking for their low risk reward. Their stop losses are down here, and then price comes down, takes out their stop losses, takes out all the liquidity that was already below the low right here, and then our zone just shoots straight to TP. This is a very A+ example of the strategy. All these trades you can see on screen right now happened just last month on one pair. This is a different time frame, but the trades itself play out exactly the same. But of course, in this video, I'll be going through the 5-minute specific rules for it. But once again, right here, you can see we had our demand area, we pushed up, investors missed out here. We then came down without touching the zone. So we have our level of liquidity right here. We have our demand zone. We then came up, breaking the high to the left. This is our break of structure, and then came down to the zone, got our rejection, and the rest was history. This was just a 1 to 10 very quickly. Yeah, it's great. I could show you examples for literally weeks. This strategy has been playing out for decades, so it's tried and proven, but you can see the general way the strategy plays out. So first things first, with some rules that must always be followed no matter what the circumstance. Coming first with the fact that zones must always be untapped. So you've seen in all the examples, we've created our demand zone, we've come up, we've come down with our liquidity, and we did not tap the zone. If this comes down into the zone and then shoots up, you know, making your break of structure, if this then comes to the zone, it's invalid. Investors have already got their better price here. It will then usually continue down. The win rate will just be so much lower. So for example, right here, you might see this demand zone. You might think the liquidity is looking beautiful on it before we've come up and broken the high to the left. And if price comes down, this might be a good looking trade to you. However, this is completely invalid because the liquidity has touched the zone. Trust me, it's not worth taking for your win rate. Your win rate will absolutely just dump if you take setups like these. Or for example, you might see this demand zone right here. This is also invalid simply because we've had a black candle touching it. When marking our demand zones, all we want to see is bullish candles connecting to it. If there's been a bearish candle at any point and then it touches the zone, that makes it immediately invalid. So don't be looking for zones like these. We just want clean price action, a very clear demand zone, etc. Same with supply zones. So say you see this zone up here, this is just invalid because we just haven't really shot down quick enough. Investors have had their time to get in at this area. If we come back up now, this is just not what we're really looking for. You can see we've got our supply area, a bullish candle's then moved into it. If that happens at any point other than, of course, when it's your entry, then yeah, it's invalid. Secondly, candles must never close inside the zone. This one's very simple, but when we are getting a rejection from our zone, when we're actually looking to potentially take the trade, we need to see a rejection. If this closed inside the zone, it's immediately invalid. I know it might seem tempting sometimes if it closes inside the zone and then you start seeing a rejection, but trust me, it's just not worth it. The win rate is ass if you do that. You can see on all the examples, there's just a wick rejection. It never closes inside the zone. It doesn't have to immediately turn bullish. As you can see here, we rejected from the zone a bunch of times. Even if it's a black candle, that's fine. Just if it closes inside the zone, then it's immediately just invalid. So for example, if this was a zone we were looking at right here, the second this is closed just inside the zone like this, it's immediately something we would skip out on. So that's just another no questions asked, never take setups like those. Thirdly, liquidity must always break its own high. So this is the break of structure part that I was talking about. Now this part might be a little bit more difficult to understand. You'll easily get the hang of it once you know kind of what's going on. But this is literally the part that I explained earlier with the break of structure. I got plethoras of content on this strategy on my channel if you still don't understand it after this, but it should be simple enough. So once again, in this example right here, when we came up, this is the high that we originally made that then came down and made our level of liquidity. So this is the bit of structure that we need to break in order for this to be valid. I'll show you some more examples here because that might not have been too clear. But right here on this setup, obviously the liquidity looks a little bit strange on here, but you can see we came up, formed our demand zone, had our little retracement where we created our liquidity, and from here, this is the high that we would need to break in order for it to be valid, because this is where we came down and made the liquidity. Once again here, I've already got it marked out. We came up, came down, made our liquidity, and this is the highest point of the structure that we made before coming down to liquidity, so this is the high we need to break. On this one right here, I'll give you a moment to think about it yourself, but we came up, forming our normal demand zone, came down, creating our level of liquidity, so where we need to break right here is right here. This is a pretty clear example, I feel like. Once again, if you're still not completely understanding it, then there are lots of videos on my channel where I kind of explain it, or just lots of examples of setups in general. But if you are confused at any point about anything in this video, or just want more personal assistance, or want to know what types of trades I take with this strategy, then I would recommend my VIP Discord in the description. You don't have to join, like I said, there's a bunch of content on my channel, but there is lots of extra content in here. I show my own trade ideas, I do weekly webinars, there's lots of extra videos, and lots more, as well as just an amazing community in here. So if you are looking for any more personal assistance, then this would be the place. But finally, on these quick universal rules, I just want to show you how to draw supply and demand zones. Now I'm sure most of you have seen how most normal supply and demand traders draw out their zones, and for a lot of the time this is the exact same for us. Now what I mean by that is, in a demand example, such as a few that we have on screen here, all we'll do is mark out the bearish candle before the large move. That's literally it. Just when you see a big move up of a bunch of bullish candles, you mark out the bearish candle before that big move. You'll see examples literally everywhere for it. This is how most people mark up their demand zones. And of course, with supply zones, up here, we'll just mark out the bullish candle before the large push down. Again, right here might not be the prettiest example, but this is exactly how you would mark up this zone. Just the bullish candle before the big push down. I can see another demand example over here. Mark out the bearish candle before the big push up. But in most cases, this is how we draw our supply and demand zones. However, we do quite often have one small thing that we do change of our drawings of supply and demand zones, which we call accuracy zones. Now, all this is about is whether the candle we are marking went higher than the preceding candle. So I've grabbed an example right here used from RD a while ago. If you don't know who RD is, he's basically the original creator of the strategy. All love goes out to him, that's where I originally learned it. But basically, with the normal way of drawing up a supply zone, we would draw up the entirety of the green candle just like this, as you've just seen. However, the accuracy zone version of this drawing would be just like this. We would only mark the body and the upper wick. This is simply because the green candle wick went below the preceding candle, aka the red candle after it right here. And this stands no matter what. It doesn't matter how the body of the candle looks. For example, if it was drawn out like this, definitely a dodgy drawing, but the supply zone would then be marked out like this. It would just be around the body and top wick, and we'll just leave out the bottom wick there. Just follow this exact example for supplies and vice versa for demands. Obviously, I'll show you some more examples. But the reason for doing this is, once again, banks, institutions, etc. will always want a better price. Like, obviously, why wouldn't they? But as you can see here, you can pause the video if you want and read everything here. It's really good information. But this makes for a 10 pip lower price for anybody selling here instead of here. Once again, 10 pips is equal to millions to these institutions. But let me just show you some real examples right here. To be fair, I see one literally on my screen right now. So for a demand example right here, you can see we had a black candle right here before a large push up of bullish candles, and instead of drawing the demand zone up like this, which would be the normal drawing, since this candle wick went above this next bullish candle, we'll draw it just by the body and lower wick. And to be honest, this just looks much cleaner. This is actually a demand zone that I would probably take. You can see we have our level of liquidity right here. You can see we have our break of structure right here. This isn't the point of what I'm saying, but I'm just pointing out, if this was drawn up like this, it's still valid, but it just doesn't look as nice. If you get a big reaction from a smaller zone, then that means you have kind of pinpointed a very good area. And usually those zones kind of win a little bit more, which is the great thing about accuracy zones. But let me find some more examples real quick. This is an example right here, I suppose. It's a bit weird. Obviously, there's no valid setup here. We don't have liquidity or anything. But for a demand zone like this, obviously the normal drawing that most people do would be like this. And even though an example like this, it really doesn't matter too much, we would always draw it just by the body and lower wick. Well, and we include the bottom wick of the bullish candles. I'll explain that in a moment too. Once again right here, instead of drawing it like this, where this would just be a completely invalid zone, this just looks awful, it's closed inside and everything, we would actually draw it like this, just with the body and lower wicks below it. And now, this has actually formed a valid zone. You can see we've got our liquidity right here. You can see we've broken the high. This is a valid zone to take, in which would not be valid if it looked like this. And these type of zones win quite a lot. But in regards to marking out the bullish wick below it, this is just something we always do. If the next candle's wick goes below, then we'll just include that instead of like this. It usually doesn't make too much of a difference, but if it's a small black candle, then it can. So we always include that bit of the wick. I'll just quickly find a supply. No, never mind, I found one. Right here, you can see we kind of had this push down right here. Instead of marking out like this, we would mark it out like this. Same down here, you can see so many examples just throughout the market Obviously, a lot of these are not zones we'd take, but I'm just showing you examples of how they are drawn out. Once again, you can see on my channel so many examples of accuracy zones if you do not understand it, but I hope that was a decent enough explanation so you can kind of understand it and try it yourself. Oh, actually, one more thing before I get into the proper rulebook, just based around liquidity. This is actually really important because a lot of the time liquidity can be a pretty confusing factor to this strategy. So I think I see a decent example here. Let me remove all this. So in terms of good levels of liquidity, obviously we have the zone down here, which is the one we would be interested in. We've got a really good level of liquidity. This forms a proper low. It forms a demand zone to fake out normal supply and demand traders. This is a great zone. We've got everything going on for us here. There's no reason not to like that. However, one thing that technically counts as valid liquidity and technically makes this a valid zone right here is this black candle, okay? Basically, we've come up, we've formed our demand zone, and then we've come down, formed this black candle. This is technically a level of liquidity, but it is extremely low quality. Generally, the less candles, the worse. And that's because less liquidity will be sitting under it. The only benefit of this right here is that this has formed a fake out zone. Some normal supply and demand traders will be interested in this, but you can see here, it didn't give too good of a fake out anyway. So this is definitely not something we'd ever be considering. Occasionally, one candle liquidity can look good if you get a good fake out from it and it's right near the zone and it's just like very specific liquidity. I'll show you more examples in a bit because that's not a great explanation, but generally you want to stay away from one candle liquidity. In fact, just do stay away from one candle liquidity for now, especially for the 5 minute. I've seen much more success with only 2 candle liquidity. So honestly, just try and scrap setups like these. What we're really looking for is 2 candle liquidity or more. As you can see right here, this is what would be considered 3 candle liquidity, and that's because we came up forming our normal demand zone and then came down with 1, 2, 3 black candles. With 3 black candles, that can form a proper low before it then continued up, breaking the high to the left. So we have a proper low right here. Before it continued up, it left behind this demand zone, like I think I talked about already. We got a fake out from it. But this is a very safe setup because we have the level of liquidity as an actual low. Over here, you can see this is a proper low of liquidity. We came down with a bit of consolidation, formed a proper low right here before then continuing up. A decent example of 2 candle liquidity is right here. Obviously this setup itself looks a bit weird because I believe this was a news candle, but just ignore that for now. You can see we've had our demand zone. This would be normally drawn up because it didn't go higher than the next candle. We obviously came up and then came down with 2 black candles. So this is 2 candle liquidity. This is the minimum we need to see in order for a setup to be valid. And then of course we came up, broke the high to the left that was necessary before coming down to the zone. But this is 2 candle liquidity right here. Anything more than that is fantastic. But 2 candle liquidity is the minimum as it forms a proper low that liquidity will very safely be under. If you're taking all the 1 candle liquidity setups, then you'll see so many setups and it will become very saturated and you'll be taking lots of trades and your win rate will be very low. But you can even see here, this is technically 2 candle liquidity because the lowest bit of liquidity right here is this. You can see we came down with 2 candles, formed our low. It's not too significant of a low, which is why realistically this is the level of liquidity that's quite important for this size of structure, but this would technically be valid. But any more structure than that is just a bonus. So when it comes down like this, you can see it's like 5 black candles or whatever. This has formed a very obvious low. Very obvious liquidity is going to be below there. No complaints would be had. This is a very obvious trade for us. But everything I've basically just explained so far is valid for any time frame you want to trade. Like I've said, I mainly trade the 30 minute. Everything I've just explained would work perfectly for that. But now what I'm going to be talking about is very generally for the 5 minute. These are going to be some more specifics that you need to take in mind when taking trades. These are the very important things people need to know in order to be able to trade the strategy on the 5 minute time frame. So let me just get into it. Starting off with entries. Obviously every strategy needs a good entry model. Without it, it's pretty useless. You need something that can stay consistent, something that's worked over years, something that works in backtesting and live markets. And starting off with something extremely simple is the directional close. Now what I mean by this is once we've entered the zone, we've reacted, we've rejected, we're just waiting for a bullish close. In a demand example, of course. So as you can see right here, we were rejecting the zone with multiple black candles, but we never closed bullish until this one right here. So this is where we'll take our entry. Now what's so great about this is that you can do this in back testing and it will be the exact same in the live markets. I'm sure lots of you have traded strategies before where you'll be very profitable in back testing and you'll be wondering why you can't convert it into live markets. And it's very often due to things like these. Your entry models will be very difficult to replicate just based on guesses on how candles are forming during back testing. if that makes sense. But if you're just entering on the candle close, then you literally can't go wrong. You can trade exactly as you would in live markets, and it's very consistent. This has been working for years. All the other entry models that I'll talk about after this are basically just trying to predict the directional close before it happens to get a better entry. If a high quality trade closes in your direction, then there's a very, very high chance that it wins. Now, I could show you examples of this forever because 90% of our trades will just be the directional close. But right here, once again, you can see we made our setup, we entered the zone. This one, not too much faffles about it because we just closed bullish immediately, but this is exactly where we'd enter. You can see it's done very easily in backtesting. You can do this the exact same in the live markets. There's nothing really that would change about it. It's just whether you can be patient to really wait for that bullish close, because I know a lot of people struggle with that. But yeah, in a supply example, it would just be the complete opposite. You'd just be waiting for a rejection and then a bearish close, and you would enter on the bearish close. Generally, this is what you'd be doing. Once again, very simple stuff right here. And this is what I'd recommend to anybody, especially new to the strategy, to do basically all the time. There's not really too much reason for you to use any other entry model, but there are some ways if you're trying to really maximize the profits of the strategy that I will go through now, because I hope that shouldn't be too complicated. So secondly, I want to talk about break of candle entries. Once again, in a supply example, this is basically just predicting that it will close bearish from an earlier point. This won't happen nearly as much as just normal candle close entries, but you can see here we had our 2 candle liquidity, broke the low, even breaking lows to the left over here, then came up, rejected the zone. We didn't close bearish straight away, so we wouldn't enter yet. However, we also don't want the trade to leave without us. As you can see, with this same risk to reward, if we had entered on the close, this would have been a 1 to 1.5 instead of a 1 to 3. Basically doubles our risk to reward if we can just predict the entry a little bit earlier. But all that's happening here is we're waiting for this candle to break past the previous one. I'll go into replay mode quickly. You can see this candle is obviously the one that's entered the zone and is rejecting. So all we need to see in order for us to enter would be probably to make an upper wick quickly, and then to just break past the low of this candle, which right here, boom, would enter right there, because he broke past the previous candle. And yeah, this would save your risk reward by quite a bit in comparison. Once again, right here, you can see we entered our zone. Actually, by the way, this is a perfect example of why accuracy zones are good. You can see here, this would have technically been a tap zone if we just drew it up normally. This isn't something that we would enter off, but this makes it valid because it was drawn as an accuracy zone. So that's why that's very important. But yeah, you can see here, we rejected the zone, we closed bearish, and then the next candle, instead of waiting for the full close here, which would have given us a 1 to 2 just around these highs, we are instead getting a 1 to 4 pretty much. So basically doubling the risk to reward by just waiting for us to break past this candle instead of waiting for the close. Once again, beginners, I'd recommend you just enter on the close. Still very profitable. You can see this would have won very easily if you just entered on the close. Doesn't really matter too much, but in some situations it can help you out if you're trying to maximize the profits of the strategy. But next up, this is a bit more complicated. These are higher time frame flip entries. Okay, so basically, if I go into replay mode real quick, you can see that on the higher time frames, basically every candle has an upper and lower wick, okay? This is just the markets filling orders before going in the direction that it would usually go in anyway. So on the 4 hour, basically every candle has an upper and lower wick. On the 1 hour, same thing. Even on the 5 minute, almost every candle does. But on the higher time frames, we like to wait for these wicks to be created before we get into our positions. So right here, instead of taking a close entry, which we'd usually take, once again, wouldn't have really mattered on this trade, but sometimes it can give you a crazy risk to reward, so it can be worth it if you're maximizing the profits of the strategy. But right here, you can see the candle that came into the zone right here was at exactly 9 o'clock. This was 9 AM, so a new 1 hour candle would be opening, a new 30-minute candle would be opening, etc. So what price has done here is it's created that top wick very purposefully. It's filled in some orders and then it's flipped. And we can take our entry on the flip of this candle because we know that the higher time frames have purposefully made their top wick and then want to go bearish. And this happens so frequently to where if this had closed bearish without making an upper wick, we just wouldn't have entered in general, because what the price will usually be doing in that case is making a bottom wick to then go up. But we made our upper wick and then we just shot down and went straight to TP. You can do this on new 30-minute candle opens. You can do it on new 1 hour candle opens. I mean, obviously a 30-minute and a 1 hour kind of would be the same. But these higher time frame candles like to make upper and lower wicks, so this is very good to sometimes increase your risk to reward. This is pretty rare that this will happen, but sometimes it can be great to have your best trades ever. So It may be nice to know once you're a bit more experienced with the strategy. And yeah, I don't really have too many examples of this because it generally doesn't happen too often, but hopefully that should show you all you really need to know. If it's confusing, then I'll have more content on stuff like this in the future. But next, we have times to trade and times to avoid. So for my trading hours using the 5 minute, I trade from 7 AM till 9 AM UTC. This is just because I don't really like to dedicate too much time to sitting at my desk trading, because my main time frame is still the 30-minute charts. The 5 minute is just great for some extra profits. I'm sure some months I'll literally be making more profit from the 5 minute than the 30 minute. But trust me, those 2 hours are enough to make me a bunch of extra profit on each month. But just because they're my trading hours does not mean it doesn't work during other hours. I've seen lots of trades win between 6 AM and 10 AM UTC. And I've heard lots of people having success around 12 PM to 2 PM, once again, UTC time. However, one time that I have noticed does not work quite as well. This might be a bit random, but at 11 AM UTC, it seems to not work as well. Now, why is that? I think it's simply because institutions and investors and stuff, they just go in for lunch, so they're not at the markets to be trading. Sometimes you just got to think of trading as simply as that. That is genuinely probably what it is. Investors are going for their lunch, they won't be at the markets to take these trades. So I always avoided trading at that time. Yeah, that's just quite a funny detail to add. But another time you want to avoid trading is 5 minutes before a new 30-minute candle open. This is just because the next candle can do pretty much anything. For example, this is 5 minutes before a new 30-minute and a new 1 hour candle. So if this candle had closed bearish right here, we wouldn't enter. And this is A, because price will likely want to create a top wick before going in that direction, so you've got to give it space to do that. But also, usually, higher time frame candles come with a lot of momentum when they first open. So this can really do anything, it can be extremely unpredictable, so you generally just want to stay away from it. Higher time frame candles are very volatile usually on the open. So if something like this does happen, you feel me, a candle closes 5 minutes before a new 30-minute candle and it's given an entry, just give it a little bit. Maybe occasionally it will just run off without you, but it's definitely the safer thing to do so. Preserve your capital, that's the most important thing about trading really. The only exception to this rule is maybe if the candle had closed all the way down here, because then you've got lots of room for it to create that upper wick, lots of room for it to go crazy and do whatever. But yeah, generally try and avoid it. Now the next thing I talk about might make a lot of you pretty happy, to be honest, because I know a lot of people struggle with trend, but what this is about is that trend doesn't matter too much on the 5 minute. I always see people doing deep analysis on the 4 hour time frame when they're trying to trade the 5 minute, and I'm just thinking, why? Because let's just get a measure of one of these candle wicks. These are all pretty average length wicks over here. So this wick is 1.2k pips, I suppose. Gold's a little bit weird. This one over here, 900 pips. This one over here, 600 pips. So just think about that, all right? And then the trade that we took is 400 pips. So our trade could simply just be a wick on these higher time frame candles. Same with the 1 hour. Let's go into the 1 hour. This wick over here, 600 pips. This wick over here, 700 pips. Even the ones down here. That's like the whole move. So there's not really any point in analyzing these higher time frames, because we could literally just be making a bottom wick before it then continues in the direction it wants to. Even though a lot of the time, it will just continue in that direction anyway, so it doesn't even matter. Now, obviously, it does not hurt to be in trend. On the 5 minute especially, you want to be somewhat in trend. If you're reacting from a bunch of supply zones, coming down to a demand zone, then you might want to avoid it. If you're just making very bullish market structure and you randomly make a shitty looking supply, doesn't mean you should take it. You still want to be taking the highest quality setups, but I'm just saying, don't bother analyzing the hour time frames. I literally just stick to the 5 minute personally when I'm trading the 5 minute, because these moves that we're catching are literally nothing in comparison to even just a wick with the higher time frame candles. So it still matters, just not as much. And now finally, TP and stop loss rules. This is obviously extremely important, and there is a very perfect set of rules that you can just use to trade pretty robotically using the strategy. You don't have to make your own TPs, you don't have to make your own stop losses based on the trade. You just look at the set of rules, take your trade, set your TP and stop loss, and you can walk away if you'd like. Once again, shout out to RD, he's made these rules. He's shared them publicly on his channel before, but these are very important. So let me just basically go through what we're looking at here. So these are between two different pairs. Currently, the only pairs I'm trading are GJ and gold. Once again, personally, I'm just trying to not, have any stress whilst trading the 5 minute. It's just for some extra profits. I know there are some other pairs. I believe EU, Euro USD is also pretty good on it. But these are the rules for the two pairs so far. This one is for GJ and this one is for gold. So I'll remove this one for now. So let's just go through some trades using these rules. But firstly, let me talk about stop loss. There are now new rules in place for stop losses. We used to have it 1 pip above the candle that entered the zone. However, now we just have it just on top of the candle, just exactly where the candle is. This will increase your risk reward by quite a bit, and from testing, every time it goes up there, it will just lose anyway, so there's literally no point in giving it that extra room. So stop loss directly on top of the candle that entered the zone. Pretty simple stuff. I'll show you some more examples of that as we go through the TP rules. But for a stop loss of 50 pips or less, minimum RR would be a 1 to 4.5. As you can see on this one right here, the stop loss is 114 pips. So you can look over here. For a stop loss of 100 to 150 pips, close full at 1 to 2.5. So our full TP would be right here. This would have hit within 2 candles. And to be safe, if you want, once you hit a 1 to 2, you can move your stop loss to break even. This makes it so the win rate is extremely high. Once again, if you've ever seen or traded normal supply and demand for yourself, you will have definitely seen people going for 1-to-1 risk to rewards. So this is already immediately better than that. This is double in just a trade with a fairly wide stop loss. All right, so boom, right here, we have another trade. This one looks like a very wide stop loss, so we'll expect a smaller risk reward. Stop loss is 211 pips, so 200 plus, just close full at 1 to 1.5. Just like that, stop loss hit within basically 1 candle. No stress involved. That's what's so great as well. There'll be no psychology really needed to be involved in it because TPs will hit so quick. Boom, over here, stop loss of 339 pips. Very wide stop loss. Close full at 1 to 1.5. I've already done that. But a lot of the time the stop losses are way smaller, so you can get extremely good risk rewards on these. Let me go to this GJ trade that I literally took 2 days ago in the live markets. So if we get our GJ rules out, we entered this just on the close, I believe. So 14 pips, stop loss of 11.1 or above, close full at 1 to 2, which is exactly what we did. On the proper close entry, this was just a 1 to 2 within 2 candles once again. Absolutely gorgeous trade. Feel free to get a screenshot of these. This is the one for GJ right here. Feel free to take your screenshots. And this is the one for gold right here. So shout out to RD for them. I shouldn't really have to explain this all too much. Obviously with these rules, there are also break-even rules. So for example, with a stop loss of 150 to 200 pips on gold, you'd have your minimum RR at 1 to 2, so that's where you'd probably take your full TP. And then once you hit a 1 to 1.75, you can move your stop loss to break even if you'd like. But that's about it for that. Once again, they should not be difficult to be able to read really, so that shouldn't really be too much of an issue. But there is one more thing I want to talk about before I end this video, and for it I'm going to need these TP rules back for gold. So on a trade like this, of course our stop loss is 226 pips, so for a stop loss of 200 plus, close full at 1 to 1.5. So this is generally what we'd be looking for. However, if you want to increase your risk to reward, once again, this is quite an advanced thing. I wouldn't recommend doing this or even thinking about it at first, but maybe once you're a lot more advanced with the strategy, you can do it. But basically, you can do a 1 minute trailing stop loss, and to use this, basically what we're looking for, or what we're doing, is once we've hit our TP, we are then putting our stop loss below each bullish candle that closes. So once we hit TP right here, we would then have our stop loss below this candle right here, and then once this candle closed, our stop loss would then be under here. Then we had a bearish candle that obviously didn't go down there, we wouldn't move our stop loss. Then we had a new bullish candle, so our new stop loss would be here. Then we had a bearish candle that didn't tap it, we wouldn't move our stop loss. Then we had a new bullish candle right here, and then another bullish candle right here, and then a bearish candle finally came out and stopped it out. So this is where our final TP would have been, which would have made our risk to reward a 1 to 2.8 instead of a 1 to 1.5. Is this completely necessary? No, a lot of the time. It's just whether it looks like it has potential for a bigger risk to reward. Such as right here, this is a very large structured trade. It feels like a waste to only go for a 1 to 1.5 on this when it looks like it has so much bullish potential. Even if we go into a higher time frame, you can see this is fairly large structure. We've came to right to the bottom of this area. This is a perfect place to actually go bullish even on the higher time frame. So you can see this would be kind of a waste to just go for this small risk to reward. So it's only times like that that I would do something like this. Once again, we have this trade right here. If I get out the stop loss rules, this was 148 pips, so close full at 1 to 2.5. If we go into the 1 minute for the trailing stop, we hit TP here, so our stop loss would then be moved up here. Then it was a bullish candle, then a bearish candle, so it'd be here, then it would be here, then it would be here. So a lot of the time, it literally might increase it by, I mean, that's 0.6%. I know it doesn't sound like a lot, but with 100K in funding, 0.6% is like $600. That's nothing to scoff at. Literally just getting small extra profits like that can easily get you out of drawdown if that's your situation. It can be great extra profit if not. But yeah, I think that's literally it for this video. Please ask any questions you may have in the comments. I'll try and get to you. I'll be giving more personal assistance in the Discord as always. I get to all those questions. I'll be going through more of this stuff in the webinars. But yeah, I recommend you go backtest all of the information that I've just given you. Feel free to come back to this video, screenshot any information you may need. I already have lots of students doing very well on my Discord, passing challenges, etc. So there's lots of people that know this strategy is incredible. Go back test it, try it for yourself. Let me know how it goes if you're having any issues, any complications, etc. And yeah, I'll see you in the next video, man. Like and subscribe, follow the Insta, and yeah, peace.